Hello, everybody, and welcome to June's Markets Monthly. My name is Doug Huber. I'm the Deputy Chief Investment Officer here at Wealth Enhancement. I'm happy to be joined by Gary Quinzel, our Vice President of Portfolio Consulting, and we're going to do a rehash of what's gone on over the last month. You know, it's funny that we sit here today, and as of recording, I just looked, and the S&P 500 is within 50 points of its all-time high that was reached in the middle of February, and I think, you know, if we had just all gone away for 4 months and come back, I think all the stress and agita that the markets have given us would have seemed like nothing. It would have been all in the background. But you know, it's funny that we find ourselves here after 4 months of really elevated volatility. I think for the month of June, you know, the equity markets certainly remained very strong in their recovery based on the back of cyclical stocks outperforming. We've also continued to see the trend of international stocks and emerging market stocks outpacing the US so far year to date. And I think a lot of that we'll talk about a couple of reasons going forward, but a lot has to do with the decline in the value of the US dollar. For the month, fixed income was really flat. For the most part, this is really hinging on the fact that there's a lot of concerns around our fiscal budget. All right. I think with this introduction of one big beautiful bill, and we'll talk about that in a little bit, alongside potential debt downgrades, what the Fed's path is, what our cost of debt is. There is some looming concerns of what is the outlook for rates from here. We still have a lot of tariff uncertainty that hasn't been solved, although there certainly appears a path to solving it, and we've had some developments occur as it relates to our negotiations with China, a little bit further negotiations in Europe and other areas. And so I think, you know, while that uncertainty still exists, standing at the edge and peering into the abyss is slightly, you know, we're in a better spot than we were. And I think the market's kind of evaluating what the future outlook for that is. And so we'll compare a little later, you know, what are the consumers and business sentiment versus what's actually going on in the economy and how's the market reacting to that. And then I think I'd be remiss to say that in the month of June, we've also certainly had a lot develop in terms of what's going on from a geopolitical standpoint. We've obviously had a lot of turmoil in the Middle East. You know, I think the market has generally shrugged that off, believing that, you know, a solution set is in front of us, that this was more a jockeying for position than an outright war, but there's still a lot of uncertainty there. And so that is something we're certainly paying attention to. But with that, I think I'll hand this over to Gary here, and maybe he's going to provide us a little bit more on market updates for the month of June.
Thanks, Doug. Hello, everyone. So here on this slide, we have performance through May 31st, which is admittedly a little dated at this point. For a variety of reasons, we're coming to you a little bit later in the month than we typically do. So I'm going to walk through this chart, but also provide some other timely updates. Here we are later in the month of June. But as you can see on the table here, we're showing both quarter to date and year to date performance. And as Doug highlighted, you know, it has been quite a bit of a round trip, particularly for US equities. And again, as Doug mentioned, it's been really driven by those cyclical sectors, and most notably that of the technology-driven NASDAQ, which we don't show here, you know, but has had quite an impressive quarter. If we look at, you know, the NASDAQ 100 year to date, it's up around 15.5%. So while those stocks, many of which are noted in the Mag 7 and other technology leaders, were some of the biggest decliners in late Q1, early Q2. Many of those stocks are also the ones that have been driving this recovery, but it hasn't been confined just to those large stocks. We've seen a pretty broad recovery, and if we really look across the board, we see strong performance, you know, from the S&P 500. Not quite as much from small caps. Small caps are still in the red this year, even after climbing around 3.5% so far in June, in addition to the performance you see on this chart. It's the one major sector or asset style that continues to be negative. But international has really been probably the story so far of 2025. We've been talking for years, it seems like, about how undervalued international equities are relative to the US, and we've continued to see this US exceptionalism take place, in which, again, those technology-driven sectors, and here in the US, where it makes up a bigger part of our index, have really driven that outperformance. But this year has not been the case. We've actually seen continued strong performance from both developed international as well as emerging international, and we've continued to see that trend here in the second quarter. Now, ever since the recovery here in the US, which really began on April 8th, US and international, for the most part, have been on par with one another, but the big difference is international did not have that steep sell-off earlier in the year. So we can see that the performance for both international, developed and emerging continue to be well ahead of the US. So for an example, the EAFE index is up around 18.2% year to date, and 14.37% for the emerging market index. And some of that also has to do with the underperformance of the US dollar, which I'll talk about in a little bit. Last thing before we move on, I just want to talk a little bit about rates, because for a lot of our investors who are invested in bonds, bonds have certainly underwhelmed relative to equities for several years. A big part of that was the rising interest rate environment, but we have seen rates steady out a little bit. And even though rates have come in a little bit in the past month or so, we still have a pretty healthy set of yields across the curve, north of 4%. And we're going to talk a little bit about some of the concerns around the fiscal environment, but we haven't seen any type of material spread widening outside of some separation in the muni market, which I'll talk about in just a second. So if we jump to the next slide, I want to just highlight on kind of the timeline of this journey that we've been on. We keep adding to this chart. It keeps getting busier and busier. We might think we're pretty much out of space here in terms of highlighting all the different things that have happened. I'm not going to recap every single bit of news here, but suffice it to say, it's been quite a journey and quite a roller coaster of a ride. We're at all-time highs back in February. We fell to bear market territory following the Liberation Day announcement. Feels like a world ago at this point. And then we've had this sequence of more positive events, with starting with the announcement between the US and the UK. And of course, we had the moratorium put on all other countries for 90 days. And then the bigger announcement, which really set the market off, was when the US and China agreed to hold these talks. And we've seen positive developments there in the month of June as well. All of that has created a more friendly risk environment and such that investors are feeling better about the overall situation. And as we've said in previous webinars, we're not out of the woods yet. We fully understand that. Doug is going to talk more about it from an economic fundamental standpoint, but from a market standpoint, we're starting to adapt to the new reality that these tariffs in some shape or form are probably here to stay. Worst case scenario, at least seems to be off the table, at least in the short run. If we jump one more slide, I want to talk a little bit about the curves that I referenced a moment ago. As I mentioned, we have seen rates come down a little bit this year, really on a parallel fashion from around 3 years out. We're looking at the 10-year around that 4.3% mark. But one of the interesting stories that I think has developed is we saw an opportunity in the muni market. It really peaked probably late April when, just generally we saw more concerns around riskier assets. Not to say munis are risky by any stretch, but what we did witness is that ratio of muni yields to treasury yields actually got a little more attractive. And today, even if we look at the taxable equivalent yield of munis relative to their treasury counterparts, they're still generally over 100% on a tax equivalent basis. And anytime that happens, it does present a more attractive opportunity. And so when we look at the ratio without the taxable equivalent part, we can see more attractive levels than we've seen for the most part over the last 3+ years, going all the way back to 2022. The entry point might not be quite as attractive as it was in, say, late April, but again, we're not market timers. We're never trying to find that perfect moment. The takeaway here is that there are more attractive entry points for those investors that are high income earners and are looking for a good time to think about adding municipals to your portfolio. With that, I'm going to hand it back to Doug to dive on some of the economic updates.
Thanks, Gary. Appreciate that. That was a great highlight of what was going on in the markets. I think, we want to talk about really what's going on at the core of the economy so far year to date. We're obviously still paying attention to what could be coming down the pipeline, and a lot of the market is trying to figure that out. But I think it's really interesting, what the market was assuming just 3 or 4 months ago of the impacts of these tariffs and what that would do to the economy hasn't really come to fruition. And so we look at a lot of things, but obviously one of the biggest ones is the labor market. We talk a lot about in our videos the strength of the consumer, and how that has really been the bastion for the strength of our economy over the last several years. And I think a big piece of the strength of the consumer, as you'd imagine, is obviously the strength of the labor market. And so you can see that while we've seen a little bit of a tick up in non-farm payrolls, meaning like jobless claims, the fact of the matter is that, we are still well below our pre-pandemic average. And so this is to say that the labor market remains quite strong. Earlier in the year, we were monitoring job openings, for instance. That it can be a harbinger for kind of what's to come. Typically, companies will stop offering openings before they'll start cutting positions. And we did see that job openings decline for a while, but we've actually seen more recently that number start to level off and come back a little bit, meaning that businesses are comfortable saying, hey, we're going to hire for future growth. And so it's important to say that, thus far, the labor market has remained quite strong, regardless of what's gone on kind of with the noise around tariffs, geopolitical tensions, et cetera. I think this is a big one for us, is this kind of soft data that we hear a lot about. This is the data that makes a lot of the headlines, isn't really communicating or isn't reflecting what's going on with the real economy, or what we call the hard data, right? And so if you look at this chart from left to right, what you see is more of like the strength of housing, industrial, labor market, personal and household, right? These are real numbers of the strength of certain pockets of our economy. And you can see that this economic surprise, it's to the upside. We are at these areas have been, this is hard data that's proving that these areas continue to be quite strong. However, you compare and contrast that with the right side, which is really the surveys, right? They go around and they say to businesses and consumers like ourselves, how do you feel about the future state of the economy? And it's interesting, but the fact of the matter is, at least through the last readings, sentiment has been quite bearish. It has been quite negative, right? The outlook, people are just still concerned. And so, you are seeing that play through. And so one of the things we're looking to see is, are we going to see a pickup in sentiment? And why does that matter? Well, frankly, it matters for this reason right here, right? What you can see is that this is a chart of global M&A, or mergers and acquisitions. And really this is utilized as a way to judge kind of how are capital markets functioning? Are businesses going out and investing in growth by buying other companies? And what you've seen is post kind of the Trump election, there was a lot of optimism that M&A activity was going to pick up on the back of kind of decreased regulations. Well, unfortunately, that did not come to fruition. And then with the uncertainty kind of that came into the markets via these tariffs and some geopolitical tensions, M&A deal count has cratered, probably to the lowest level we've seen, back to periods in the great financial crisis and into the COVID era. And so what that's telling us is that thus far, businesses are not willing to kind of extend the incremental dollar to really kind of put their neck out there to invest kind of in the future of their businesses. And if they're doing so on the margin, as opposed to going out and doing wholesale transactions to buy in growth. And so this is an interesting one to watch. This isn't the only proxy, and this certainly doesn't mean the economy's coming to a cratering halt by any stretch. But it is indicative of the fact that business sentiment is still low, consumer sentiment is still low. And so what we have to see is, how long can that continue before that soft data actually has an impact in the hard data? Thus far, it hasn't. And if you see that kind of sentiment turn around, maybe it never does. And so that's certainly something we're paying some attention to. I think with that, maybe Gary, I'm going to throw it back to you, and maybe you could talk about a few things that we've been talking about internally, kind of through our roundtable of professionals, of things we're looking at, or things that have caught our eye as of late.
Yeah, absolutely, Doug. And I love the highlight of the M&A, because I think that highlights, the complexity of the environment that we're in right now. You have this rebounding market that looks so positive, yet you have this conflicting economic data. And then that's a great example of something that, you peel the layers back and you see something that's a little concerning. Again, it doesn't mean, the world is ending by any stretch, but it does represent in a very true, real way, what businesses are feeling and doing. And another thing that we have been watching, as you pointed out, with this section, we always like to kind of take kind of that longer term perspective and things that, could have a very material impact over the long run. And something that we're unfortunately all too familiar with is the ever increasing US deficit and the spending that we have here in our country. And of course, it doesn't seem like any administration in recent history has really had any intention of easing that burden. I think everyone wants to, but actually doing so is another question. And so the U.S. fiscal outlook, has just become increasingly, more concerning. And that was, evidenced by the fact that Moody's recently downgraded U.S. debt. Now that's the third major credit agency to reflect that opinion. The big takeaway here is it's not so much the rating that matters, but it's the actual net interest payments, what the U.S. actually has to pay to service our debt, which has gone up really astronomically, most notably, and it started when interest rates started going up. It wasn't a big deal when rates were next to zero, but now rates are higher and they don't appear to be going back to zero anytime soon. So what does that mean? We have 34 trillion in debt, and in the fiscal year 2024, our net interest costs surpassed $870 billion, which is more than what the government spent on veterans, education, and transportation combined. And we can see some other highlights of things that it just surpassed, things like defense and Medicaid. And this challenge just isn't going away anytime soon. And so why does that matter? Well, of course, for the broader population, that means fewer resources for other services, but for investors, we have to be very cognizant of what that means for the treasury market, and just the overall the capital markets in general, right? U.S. treasuries are the safe haven of, the investing universe, really, and they've benefited every single time we've had a risky moment. We've seen that flow into treasuries, and what will happen at one point when those treasuries look a little bit less attractive. And certainly not calling for, any type of panic moment at this moment, but it's something that we're very, very aware of and keeping close tracks on. If we jump to the next slide, one thing that it might actually play into is that of the US dollar. And I touched upon this a little while ago, how international stocks have outperformed US this year. Part of that is due to the fact that the US dollar has been on the decline. And for multiple years, US dollars outperformed a basket of other competing currencies. And we've seen that if we look at the DXY index, we've seen it well above that 100 mark for quite some years. And that 100 mark has actually been sort of a support level. When we think of it from kind of a charting perspective, every time it hit 100, it kind of bounced back up. Well, what we've noticed recently, it's kind of a philosophical barrier once you break below that 100 mark. Now suddenly that support level becomes a resistance. And so interestingly, even when we saw the recent activity in Iran, it doesn't appear that the dollar safe haven is not going away, all right, but it's not necessarily playing out the way that we've seen it in the past. And so as the fiscal situation, if it does continue to deteriorate relative to our other countries out there, one place that we could see it is in that of the dollar. And of course, that does have downhill implications. Of course, that is good for our exporters, our manufacturers that want to export, part of the administration's objectives. But on the flip side, it also isn't as positive for US dollar. And it means US stocks could have a relative challenge relative to their international counterparts. So something, again, we're keeping close tabs on. If we jump one more slide, we'll talk a little bit about what that means from the Fed perspective. Well, the Fed, of course, is hyper focused on inflation, and as they have been. And if you even listen to the recent language coming out of them, they're talking about maybe 2 cuts this year, and that's a notable separation from where we were. If we look back to April 8th, when they were pricing in around 3.5 cuts, that is down to around 1 or 2 cuts. And of course, these projections are based on Fed futures, which change by the minute. So the second we publish this, they're technically outdated, but they are directionally accurate. I can tell you that. And they do express this what we know at this time, that the Fed is not necessarily in a rush to cut rates, despite some pressure from businesses and perhaps the administration. But they are very, very focused on things like inflation, the potential impact of tariffs, the potential slowing down in the US economy. Even though we're not necessarily predicting recession at this point, there are still some headwinds out there. And so I think we're going to have to get more clarity on the impact to inflation from tariffs this summer, which is something that Powell has said expressly. With those perspectives in place, maybe I'll toss it back to Doug to take us home.
Yeah, thanks, Gary. And I think we can agree that, it's great to see that we've been able to rebound off the lows that we experienced in early April, and that, we're kind of within sniffing distance, and maybe by the time this gets published, actually have reached kind of back to the all-time highs. I think it is important to look at the economy and what is it telling us. And I think the markets have certainly come to kind of grips with the impact of this tariffs, or at least with the idea of, like, we might not know the magnitude at the end of the day, but directionally we're seeing that deals are getting done, that the knee-jerk reactions to overlay massive tariffs on all industries across all geographies has gone the other way, and that we're being prudent and that deals are getting structured. And while I might not know the finality of it all, it certainly looks like things are getting done. And like I've said all along, and I know Gary has too, the markets can handle bad news or even mediocre news. What they can't handle is uncertainty. And so as we've seen more clarity, we've obviously seen markets respond to that. I think we are seeing a small cooling in the labor markets, but as we point out, it certainly isn't anywhere near what maybe expectations were indicating, just a few months ago. And while we anticipate there could be further softening, we will see how the impacts of potential Fed policy from here might impact business decisions being made from there. I think obviously we certainly have seen a snap in this most recent period, as I mentioned at the start here, and we didn't put a slide in about it because it obviously is so new. But this uptick in tensions in the Middle East have had a very kind of introduced a lot of volatility to the commodities market, specifically oil, as the Middle East is a large oil producer, and that a lot of that oil comes out of the Strait of Hormuz, where Iranians have threatened to shut that down. It does appear that, at least for now, there is a fragile ceasefire between Israel and Iran. The U.S.'s involvement and retaliation to the U.S. for it has seemed kind of a moment in time, and so hopefully negotiations will prevail. And so you saw oil spike and then come back down. I think in total, we keep an eye on commodities to have an understanding of what the impacts are across the broader landscape. And one of the big impacts there is inflation. And that's another thing we haven't necessarily talked about here, but it's certainly something we're paying attention to as kind of the future implications for tariffs, for potentially higher pricing in commodities, autos, homes, et cetera. What does that mean for the strength of the consumer going forward? So these are all things we're looking at. That being said, we do believe there's still opportunity. We always talk about staying invested in the markets, and this last 4 months has been a great example of that, for fear that if you did kind of sell at the bottom in April, you would have lost all the ability to capture those gains and get yourself back to right where you were at the beginning of February. But we are seeing kind of, a continuing trend for a weaker US dollar. We think that will maintain. And so that typically is a relatively good piece of news for international and emerging markets. And so, we're not saying that you run towards those, but we do believe in a globally diversified portfolio. And so to the extent you might be underweight or not have exposure, it could be something to discuss with your advisor team. Gary mentioned it. Municipals continue to look relatively attractive, maybe not quite as attractive as they did at the end of April, but for high income earners or those looking for tax exempt income, munis it's an attractive entry point, and we like balancing that with some taxable credit for diversification, but it certainly offers very attractive after tax yields. And then I think in general, something we always talk about, and I don't want to belabor it, but I think it's very important. And this year has certainly been a case that has exemplified the need for a well-diversified portfolio. For many years, it was pretty easy. I think they used the term TINA, meaning there is no alternative, but it was very easy to be very long U.S. equities in the S&P 500, and very little would have outperformed that over that period. And that was great. Well, this year that hasn't been the case, right? It's important to have other aspects to your portfolio, to think about the risk tolerance and really balance and diversify those risks, truly diversify them. And we talked about some of that, whether that's fixed income, whether that's international emerging equities, potentially the introduction of alternative investments or private investments to access other parts of the economy you might not get access to in the public market. So with that, Gary, maybe do you have anything else to add? Otherwise, I think we can wrap up this month's market monitor.
I think you covered it well, Doug. Looking forward to the second half of the year. Hopefully things, smoothing out a little bit from a headline perspective, but that's what keeps things interesting. I think you said it well. Had you sold out on April 8th, you certainly would have missed out on a lot of returns. So well-diversified portfolio is the way to go.
Well, great. Well, thanks, Gary. I appreciate you joining me here, and thanks everybody for tuning in. We'll be back with you next month and look forward to the second half of the year.
Thank you.